The Federal Reserve held their big meeting, and I want to show you their plans for 2024 and 2025. So let's start with this. They decided to cut interest rates by 0.5%. So the Fed funds interest rate has now fallen from 5.5% to 5.0%. And many people are criticizing the Federal Reserve that a 0.5% interest rate cut was an aggressive move, but you could be the judge of that. Okay, so in today's video, I'm going to show you the highlights of the press conference. I'm also going to show you the projections. So I'm basically taking you to the source, and you can see everything with your own eyes. So this first video clip, the reporter asks, how quickly are they going to cut interest rates? So are they going to cut interest rates at each one of the upcoming meetings in 2024? What are the increments going to be? Will they cut by 0.5%, 0.25%, or will they skip some meetings? So Powell says, you're going to see it. He says, look at their projections, look at their SEP. They are not in a rush to cut rates. They're going to react based on the data, and they can move more slowly, more quickly, or pause based on the data if necessary. How do we figure out in the months ahead, is there another 25 or 50 coming in? Hiddleston, what shall we make that call? Thank you. Sure. So, a couple things. A good place to start is the SEP, but let me start with what I said, which was that we're going to be making decisions meeting by meeting based on the incoming data, the evolving outlook, the balance of risks. If you look at the SEP, you'll see that it's a process of recalibrating our policy stance away from where we had it a year ago when inflation was high and unemployment low, to a place that's more appropriate given where we are now and where we expect to be. And that process will take place over time. There's nothing in the SEP that suggests the committee is in a rush to get this done. This process evolves over time. Of course, that's a projection. That's a baseline projection. We know, as I mentioned in my remarks, that the actual things that we do will depend on the way the economy evolves. We can go quicker if that's appropriate. We can go slower if that's appropriate. We can pause if that's appropriate. But that's what we are contemplating. I would point you to the SEP as just an assessment of where of what the committee is thinking today, what the individual members rather of the committee are thinking today, assuming that their particular forecasts are realized. Now, Powell said to look at their projections. So let me show you those. So you can find the projections on the Federal Reserve website. It's right here. It's free. It'll take you to this. Just go to page 2 and you'll see this. So look at this section. So let me zoom in. They are projecting that the rate of unemployment, so unemployment rate, is going to peak at 4.4% at the end of this year. So we're currently at 4.2%. They expect that inflation will fall to 2.3% by the end of the year. So their goal, of course, is to get to 2.0%. So after this rate cuts, the Fed funds interest rate has now fallen from 5.5% to 5.0%. They project to cut interest rates down to 4.5% by the end of this year. So you're going to see this as 4.4% because that's the range, 4.25% to 4.5%. They project more interest rate cuts next year in 2025. They expect to cut it down to 3.5% by the end of next year, and to keep on cutting interest rates in 2026, to cut it down to 3.0%. As I told you, this is just the start. There are more interest rate cuts to come this year, next year, and 2026. Now, I want to show you this video clip. The reporter is also trying to get more information about upcoming meetings. But Powell says that the reason why they start off strong with the 0.5% interest rate cuts is because they are confident that inflation is going to come down to their target of 2.0%. And they're going to make decisions meeting by meeting. So please take a look. Follow up to that. Now that this is in the books, you can just some guidance that sort of evolves on the pacing here. Would you expect this to be running every other meeting once we get into next year? And we're gonna take it meeting by meeting. As I mentioned, we there's no sense that the committee feels it's in a rush to do this. We made a good, strong start to this, and that's really, frankly, a sign of our confidence. Confidence in inflation is coming down toward 2% on a sustainable basis. That gives us the ability. We can, make a good, strong start, but And I'm very pleased that we did. To me, the logic of this, both from an economic standpoint and also from a risk management standpoint, was clear. But I think we're going to go carefully, meeting by meeting, and make our decisions as we go. Now, I want to show you this video clip. The reporter asks if they cut interest rates by 0.5% to play catch up. Because if you remember, the Federal Reserve was saying, this was as recent as the July FOMC meeting, that they were not cutting interest rates because of the strength of the labor markets, right? And then the government, they made a revision to the jobs numbers. They said that they overestimated job growth by 818,000 jobs over the past 12 months. So in fact, the labor markets was not strong. So again, the question is, did the Federal Reserve decide to cut interest rates by 0.5% to play catch up? So Powell says, you're going to see it, he says they are not behinds, they are timely, and that this big rate cut shows their commitments to not get behinds. So please take a look. Nick Timmeros of the Wall Street Journal. Jerome, does today's action constitute a catch-up in action given recent substantial revisions to the employment data? Or is this larger than typical rate cut a function of the elevated nominal level of the policy rate such that an accelerated cadence could be expected to continue? Okay. Multiple questions in there, but so I would say we don't think we're behind. We do not think we think this is timely, but I think you can take this as a sign of our commitment not to get behind. Okay, so as I showed you, the Federal Reserve is projecting that the rate of unemployment is going to peak at 4.4%, and we're currently at 4.2%. So in the previous month, we were actually at 4.3%, so we were flirting with that 4.4% high number. So a reporter asks why the Federal Reserve believes that unemployment is going to peak out at 4.4%. Powell responds by saying that it's because the labor markets is in solid condition, that the economy is in good shape, and they're cutting interest rates to make sure that it stays that way. So please take a look. Hi, Chair Powell, Gene Smilik, the New York Times. Thanks for taking our questions. You and your colleagues in your economic projections today see the unemployment rate climbing to 4.4% and staying there. Obviously, historically, when the unemployment rate climbs that much over a relatively short period of time, it doesn't typically just stop. It continues increasing. And so I wonder if you can walk us through why you see the labor market stabilizing, sort of what's the mechanism there, and what do you see as the risks?
So, again, the labor market is actually in a solid condition, and our intention with our policy move today is to keep it there. You can say that about the whole economy. The U.S. economy is in good shape. It's growing at a solid pace. Inflation is coming down. The labor market is in a strong pace. We want to keep it there.
That's what we're doing. Now, in this video clip, the question is, what's your message to Americans by doing this big rate cuts? So Powell says the message is that the U.S. economy is in good shape, the labor market is solid, they're cutting rates to make sure that everything stays strong and good. But I want to tell you this so that you do not misunderstand the situation. So Powell is not saying that things are going to get better. He's not saying that. He's saying that he's going to try to maintain this strength in the labor market and the economy. He's just trying to prevent things from deteriorating. Very simply, what message are you trying to send American consumers, the American people, with this unusually large rate cut? I would just say that, the U.S. economy is in a good place, and our decision today is designed to keep it there. More specifically, the economy is growing in a solid pace, inflation is coming down, closer to our 2% objective over time, and the labor market is still in solid shape. So our intention is really to maintain the strength that we currently see in the U.S. economy. And we'll do that by returning rates from their high level, which has really been, the purpose of which has been to get inflation under control. We're going to move those down over time to a more normal level over time. Now, I want to show you this last video clip. The question is the Federal Reserve declaring victory against inflation? So Jay Powell says that they are not. They want to see inflation get down to their 2% targets and stay there for some time. But they're encouraged about the progress, so please take a look. Is the Federal Reserve effectively declaring a decisive victory over inflation and rising prices?
No.
We're not. So inflation, what we say is we want inflation. The goal is to have inflation move down to 2% on a sustainable basis. And, we're not really, we're close, but we're not really at 2%. And I think we're going to want to see it be, around 2% and close to 2% for some time. But we're certainly not we're not saying mission accomplished or anything like that. But I have to say, though, we're encouraged by the progress that we have made. So those are the highlights of that FOMC meeting. So I hope that was helpful. Please subscribe. I thank you for the support, and I look forward to reading your comments. Thanks so much and take care.